Rebalance webinar. We are going to be taking you through the analysis of what Gulaq did at the end of the last month, and how do we see the markets evolving. I'm Sandeep Tyagi, your host today. I'm the CEO and founder of Rebalance and Gulaq, and it's great to be here on this webinar with you all today. Please feel free to put your questions in the comments. We would be addressing them as we go along, and it is Ask Me Anything, so feel free to ask about the product or anything else about our investment processes that you are curious about. First, let me cover what is the agenda for the day. I would like to briefly introduce ST and Gulaq. Then I'll take you through the rebalance, which we do once a month. Talk a little bit about where the markets are and what does it mean for our investment process, and then open it up for questions and answers. But if there are questions in between, I would be happy to answer them as we go along. So first, quickly about ST. ST is a systematic investment firm. We have been around for 14 plus years. And we were one of the first firms to solely focus on quant-based investing. Actually, we started algorithmic trading in 2008 when SEBI actually allowed it in the country. So we were formed pretty much with the vision and the mission of being a quant-first, algo-driven investment and broking firm. We operate in 8 countries. We were given the NSE Institutional Member of the Year award in 2019, which is the last year they gave out that award, which means we had the highest volume at that time. We manage AUM of over 1,000 crores. It's probably now about 1,200 crores or so. And this is across the countries that we operate in. About Gulaq. Gulaq is our retail investment advisory brand. We provide advice for smaller investors who are on average investing maybe 1 lakh rupees, and we provide it as a model portfolio on how they can invest in a balanced way. We do have a gear-based system in which we can adjust it to your risk tolerance levels and provide you the right level of mix and volatility that would be appropriate for your situation. Gulaq is available through small case as well as PickRight platforms. It was launched in 2020. It's registered with SEBI as an investment advisor, and it has served over 4,500 subscribers already. It is quant-only, multi-factor, algo-based investment strategy. Now, I already introduced myself. I'm the CEO of ST Advisors and Gulaq, undergrad from IIT Delhi and Columbia Business School. I've been doing analytics in one form or another for 30 plus years. And I've done it with many, many different types of financial institutions. And for last 15 years, specifically focused on investment products in India and emerging markets. Vivek Sharma, who you have seen many times, is head of investments at Gulaq. He's also from IIT, but IIT Kharagpur. He's done his BTech and MTech from there and has spent 20 plus years doing trading and investment management. First, just some disclaimers. ST Advisors is a SEBI-registered investment advisor. Here is our registration number. Investment in securities are subject to market risk, so you obviously have to be careful. Whatever we are presenting here is part of an overall strategy. So if you take just one part out of context, it may be very risky for you to implement that. So it's meant to educate and teach you about how we run the process, but there are many more details that go into it. So very quickly, what is the multi-factor approach and how does it add value? We add value by creating a portfolio that is balanced and appropriate for any given situation at end of every month. We don't just look at the most popular factors. There are lots of advisors who are out there who tend to focus on momentum. That would be a popular factor. We look at over 130 factors. We also look at 18 global and macro factors, like interest rates, exchange rates, oil prices, gold prices, all of that have an impact on how various sectors will perform. We rotate our factors, so it's not just one factor that has been working constantly based on performance as well as macro regime. Then we combine these factors and using a method that we have tested over 15 years of historical data. Now, once we have built the system, we don't get greedy or afraid. So it eliminates the emotion from the decision-making process. And the benefit of it is we can continue doing investments in bull markets, bear markets, and continue to generate the kind of traction that we have been generating for now a long time. Now, getting into the rebalance. So just to remind everyone, once a month, end of the month, we rescore our models and provide a rebalance on what should be sold, what should be bought in the model portfolio. This is done across various gears. So we have gear 2, 3, 4, 5, 6. And right now we are going to be talking about mostly gear 6, which is our equity focused portfolio. In that, there is one question which has already come in, actually was the first question that came in from Abhinav Tripathi, who said, Gulaq gives a rebalance at the end of the month, but suppose there is a scam in the middle of the month, would we give a rebalance middle of the month or wait till month end? The issue with news-based adjustments is as soon as news hits, there is an adjustment in the price. So whenever there is a scam or something that will get announced, immediately the price will adjust for that. Now, once the price is adjusted, it is now anybody's guess whether the price will further fall from there or start appreciating a little bit. Both things happen all the time. So unless you are constantly available to process news and trade based on that news, it is impossible to build a model portfolio for a retail investor which is reacting to the news on a day by day or intraday basis. We do not provide intra-month rebalances normally. We believe that this is part of overall investment risk, and our process is meant for people who want to invest and not have to worry about it too much. So with that answer, let's look at what has been happening. We look at the market rebalance in many dimensions. The first one that I've presented on the sheet here is by market cap. Here, the blue part is the large cap, orange part in the middle is mid cap, and the gray part is small cap. Towards the right-hand side is what we have proposed for September month. As you can see, the biggest allocation is in the orange part, which is mid cap, which has not been the case historically. Historically, we have had very little allocation to mid cap. Most of the allocation was in large cap and even small cap previously. But right now, where the portfolio is, we see most of the opportunity in mid cap. Large cap is almost 70 to 80% of the overall market, but our allocation to it is limited. And this is in line with where we see opportunity at this point. This is sectoral allocation. So if you look at how we have picked stocks, we may have 20, 25 positions at any given month. And in those positions, if we look at what is our allocation by sector, the largest allocation is dark blue, which is information technology. The next one is light blue, which is healthcare. Then there is the deep yellow of financials. There is some light green, which is industrials. Those are our big stocks. This has been the pattern for some time. Information technology has been doing well. Industrials have been doing well over some period of time. The surprising part is financials are coming back into our mix. We have had very little exposure to financials for quite some time, but in this last 2 months, we have seen opportunities emerge, and that has now become part of our overall portfolio allocation. This is the same data presented in tabular form. I won't spend a lot of time on it. I will show you in a pictorial form. The BSE index is the first bar on the left-hand side. you can see what are the weights of various segments. The two bars to the middle and the right side is what was our weight allocation in August and in September. As you can see, dark brown again, in this case is information technology. That is much more in our portfolio than in BSE index for 500. Green, which is healthcare, is also much larger than what is the index allocation. The financial, which is a very big part of our overall index, is underrepresented. Even though it's a significant part of our allocation, it is much less than what it is in the index. So this gives you a sense of how we have allocated our weight in the portfolio in this month. Here are some stocks that we are including in the portfolio this month: Indian Railway Finance Corporation, Jyoti Labs, MapMy India, Natco, Lupin. These are some of the stocks that are coming in. The red ones are the ones that are going out: Equitas Bank, Zenza Technologies, Sonata Software, Triveni Turbine, Narayana Hridayalaya, and ITC. We don't provide the whole portfolio for obvious reasons. Those who have subscribed obviously have access to all of that information. I'm going to pause a little bit here, and I noticed there are some questions that have already come in, so I'll start addressing them. Let's see. So Rahul Kumar has a question: why does the rebalance happen monthly and not on a need basis? So because we have a systematic method, we could do it even daily, and our models can run at any given time. However, we have to balance it based on what would be convenient for our investors and what would be driving additional return in our portfolio. If we do it, let's say, on a daily basis, then the burden on the investor would be very high. These are model portfolios, which mean the investor has to go in and do some work of sending those orders to your brokerage firm. The brokerage firm has to then execute. There are costs associated with it. So if we do it very frequently, the cost will be high, and the work burden to follow our recommendations will be much higher. On the other hand, if we do it much less frequently, let's say less than a month or more than a month for every rebalance, then we start seeing the reduction in alpha that is significant. So we have, through process of backtesting and analysis, reached the conclusion that monthly rebalancing is about the right balance for us. Now, this could be done on a periodic basis. Let's say we did a rebalance whenever there was a significant change in position. The challenge with that would be communication and people's attention. Even now, there are several people who take 1 or 2 days to implement the changes that we are recommending at the end of the month. If we were to do it on a need basis during the month, we are concerned that the investors may not be able to track it precisely. They may be traveling, busy with something, not be paying attention to the messages we are sending for rebalancing. And hence, there would be a bigger gap between what we are doing and what the investor portfolios are actually delivering for them. So the right balance that we have been able to come to is to do it on a monthly basis instead of on a need basis. There is a question from Ritesh Kumar on email notifications of rebalancing detail and WhatsApp are not notified. That's a good suggestion. We would take that up, and I will follow up with the team on how can we communicate in a better way, both via email and WhatsApp. And we will address when that is live. Though every month it's the same time, but still an alert going to your communication preference would be helpful. Avya Sharma has a question. It's easy to produce results in good times. How was Gulaq's performance when the markets were not rising? So in last 3 years that we have been live, there have been poor times, there have been good times. Overall, we have been able to perform during up and down market months as well. You can see our whole track record online and make your own judgments. But we don't see any direct correlation of very significant difference in how we perform in months which are low versus very high performance months. Dhirendra Pratap Minasir has a question. I'm doing a SIP of 50,000 every month in Gulaq Gear 6. Should I keep doing this or should I put all money in lump sum at the start of financial year? Which one is better? This question, overall, I would say providing a regular SIP as money becomes available to you is a better method than waiting to put it in a lump sum. Also depends what are you doing in the interim while you're waiting to put the money in lump sum. If the money is coming every month and you're putting it in, let's say, keeping it in your bank, not putting it, instead of putting it in the investments every month, then definitely it is going to be better to put that money on a periodic SIP basis, because it kind of dollar averages or rupee averages your investment. As the markets go up or down, you participate in each part of it and build a more average price of acquisition for the stocks that you need to be. Also, as I've indicated, our returns are most optimized in the way we provide with monthly rebalancing. We do have an annual model as well, and the returns there would be also good and positive and better than index based on our analysis. However, it is a lot less than what we are able to achieve by adjusting our portfolio on a month-by-month basis. So I think monthly investment is a better option. Farid Khan has a question. Will you lock the profits in debt or gold if the times go rough? This is a very common question that we get. I think people are constantly trying to evaluate where are the markets. And, you know, it's a very difficult question to answer. Actually, if you look at this sheet, right now, Nifty is 19,500 plus. It's all-time kind of high numbers or close to it. And it seems like a little bit of a overvaluation and concern on whether one should be investing in the market or not. The problem is nobody can call the top of the market. It is impossible to figure out when to stop investing and go to a different kind of a market investment profile. So timing the market is not something we advocate. Time in the market, as is famously said, is much more important for a good investor. So we do not recommend changing or quote unquote locking or moving your assets from one to another situation month to month. It's much better for you to have an overall investment plan. There are several videos I've done in the past where I've talked about what should be your investment gear. The gear analogy is a very good one in this case. Depending on your situation, if your goals for your money are near term, then you need to be in a lower gear because you don't want too much variability. If your goals for your money are very long term, let's say you're saving for retirement, you're only 25 years old, then you can take a lot more risk and you do not have to worry about month to month adjusting it up or down. So it depends what gear can you drive your investments in. Just like a car, depending on if it's rainy and hilly, you drive it in a low gear. If it is sun and open wide road with no traffic, you drive it in high gear. Same with your investments. First determine what is the level of risk you can take. Once you have decided that, stay put in that. Of course, you have to rebalance. If one thing has had a lot of gains, it would mean that the value of that investment has gone up more than the allocation to that area. Let's say you are putting 60% in equities, 40% in fixed income. And fixed income part of it, which we, in our allocation, we include gold into that part, has gone up a lot. Then it would make sense to sell some of it and allocate it to the equity part so that you are back to 60-40 allocation. This is called rebalancing, and we have done videos on how to rebalance as well. Now, the longitudinal view is important. On this chart, you can see what is the 1 year variation of returns. If you look at it, it's anywhere from plus 100% to minus 52, 53%. So you could gain 80% or lose 52%, and nobody can really predict what is going to happen in the next coming year. But if you look at 10-year journey, then the story is different. You will make at least roughly the fixed deposit kind of a return over longish periods of time, and of course do very well if you end up in a good stretch of 10 years. So depending on your time period, you can take more or less risk. If your time period is small and you think the markets are extremely volatile, you cannot handle that much volatility, yes, of course, you must gear shift down and invest in a lower gear portfolio, which means increase your fixed income, reduce your equity allocation. Sharat Chandra has a question. It would be good if rebalance report is provided during rebalance in addition to stock addition and deletion. Well, we are obviously happy to provide the rebalance report as quickly as possible. However, we want to do this as a Q&A kind of a question and answer session. And I'm not exactly sure if there is a vehicle for delivering it through small case. Of course, we can email it to people when we complete it, but it does take us a day or two to analyze and complete the work to have it ready for your consumption. But we can reduce the time between when we provide the rebalance and when we talk about it. Another question is, what is the difference between Gulaq Gear 6 and 5? Other than the debt component, will the stocks be the same? Yes, the stocks will be the same. We simply take the equity allocation and reduce it to 80% and add a debt allocation, which is at 20%. There are other ways of handling and reducing volatility. We could have been reducing the volatility through stock selection itself, but we find that that is less effective than simply reducing the percentage of equity allocation instead of trying to pick more volatile or higher beta stocks or lower beta stocks. There is a question by Mr. Toffee. It says, is the PE price to book and Sharpe ratios updated in fact sheet in small case? That is a very good question. I don't know the answer directly, but I'm requesting my colleagues to let me know, and so I can answer that question. I'll come back to this one with you. People claim momentum to be the best factor. Any insight on it as per your experience and wisdom? Momentum is a very good factor. It works about 60+% of the time. In another sheet, let's see if I have that here. Yeah. So here is a slide which shows you which factor worked best in every given year. As you can see, momentum was the second best performing factor for 2011, 12, 13, as well as 15, 16, 17, and 19. So many, many years, it is a very good performing factor. But 2022, it didn't do well. So it also does not do well. Though I would say if you were to pick one factor, momentum is probably a good factor to pick. However, that's not the approach we follow. We follow a multi-factor approach, which means we balance different factors and rotate them based on what we think is going to be appropriate at this given time. Then there is a question, can you share past returns? This is, of course, available to all the subscribers. They can see what the returns are. Here is the chart which shows our past returns from January 2022 up to the current period. So compared to multi-cap Nifty, we have significantly outperformed. We are up about 37, 38% in this period of time, when Nifty multi-cap is up maybe 104, 105. So more than 30% delta is what we can see. More recently, if you look at it, this is the data for the month. Gulaq Year 6 has done 4.41% return. Benchmark has had negative 0.61% return. 3-month return is 17 versus 7.7. 6-month is 41 versus 17. 1 year is 45 versus 11. Now, this assumes that the investor was able to execute our rebalancing trade when we did it. Depending on when you executed and what prices you got, your returns may be different than what we are proposing or showing here. This is what is calculated as per our rebalancing advice to our investors. There is another question. What's the downside percentage Gulaq small cases have reached till the launch of small cases? So that is called maximum drawdown. That varies. There have been periods in time in history when the stock market has been down, let's say 52% in a year. We would get impacted. If you are in Gulaq Year 6, you will get impacted. And we do provide backtest data information as well in the information sheet. And that can give you some sense of how we have performed in different markets. However, there is obviously no guarantee that you won't lose money by investing in equity investment. Over long periods of time, we expect that you will make money, but on a year-to-year basis, on a short-term basis, there is volatility. Avya Sharma as a compliment, Gulaq picks are really good and some of them hit upper circuit at times. I want to wait for correction before adding more money. Is this a good strategy? I don't think that is another version of market timing. I would say you should work with the system that is being developed, back-tested, rigorously analyzed, and continue rebalancing at the end of the month, once a month, and provide money based on how you see relative performance of various investment products or ideas you have, but do it that way. Because there may be some which are hitting up upper circuit, there may be others which may be going out, and there'd be other that we will be positioning into. So for you to simply look at a portfolio and be able to guess how to time it, I think is going to be very difficult. I would urge you to impartially look at how well you can do it. Not just the one time you really got it absolutely right and avoided investing in a stock which went down and doubled down on a stock which doubled in the next 1 month. You will have stories like that, but you must evaluate based on your overall decisions. And in our firm, we have been doing this for a long time. We do not do any overrides. So nobody sits there. These are people who are very, very deep into markets and do this for daily job. And we do not encourage them to do any overrides in terms of saying, oh, it has hit upper circuit, I shouldn't invest more, or things like that. We simply go with a system that has worked over 15 years of backtest and stick with that. Nirmal Joshi has a question. Sir, can we exit from a stock when it breaks support or move towards negative trend? Nirmal, if you have a method by which you can predict what is going to happen, by all means. But I think this question of trying to guess where the stock price will go based on just their recent performance or price, this is called technical analysis. And last 50 years, there has been a ton of research and lots of Nobel Prizes that have been given out, which basically say that stock price movement is very difficult to predict and certainly impossible to predict simply by looking at price data action. So this is called the weakest form of efficient market theory. So in the efficient market, there are 3 levels. The weakest level is simply by looking at the price change, you can then decide how to invest going forward. That's very difficult to make any reliable information on it. Though, of course, momentum is exactly that, and it does do well, but you have to be careful about how you measure it, how you implement it. Second is, based on all public information, it is impossible to predict. And third level is the strong level, which says even insider information, you cannot outperform the market. Markets are efficient in terms of pricing, even insider information. Now, certainly from my experience, there is plenty of insider information on based on which people can produce very significant returns. That's why it is illegal to trade based on that. And SEBI can fine you, punish you if you were doing that. But even in case of overall information, our multi-factor approach does demonstrate that you can find patterns and invest in a systematic way. But doing it purely based on price, I think, is extremely difficult. And that's the question you're asking, if you should exit when you break a support or move towards a negative trend. There are lots of questions. Let me take the next one here. Abhinav has a question. Want to invest further in Gulaq? Should I continue with Gulaq 6 or divert some funds to Gulaq Wealth? Gulaq Wealth is a more diversified portfolio. So over long term, you would do better with Gulaq Wealth. However, in the last 2 years, Gulaq Gear 6 has pretty much outperformed everything. Even though it is a more concentrated portfolio because we have built it with a minimum investment in mind of a much smaller amount. I think the minimum investment is 30,000 or some small number like that. Whereas in Gulaq Wealth, the minimum investment is 2 lakhs, but it creates a more diversified portfolio. So if you are crossing that level, it will be better in the long term. But if you were to look at just the recent performance, it wouldn't have done as well as what the concentrated portfolio has done. However, I would urge you to again think about what is your overall mix of equity and fixed income investments. How much money do you have in real estate, fixed deposits, gold? How much money you have in equities? That balance is the first thing you need to get right. And then, of course, you can invest more if you are earning more and keeping the overall balance where you need it to be. There is a question about what is the minimum time one should remain invested in such basket funding. From our perspective, the investment period becomes less volatile and more predictable as the time period increases. If you invest, let's say, for just 1 month, it's very likely that you may lose money or gain money, but the odds that you will lose or gain money will be only slightly in your favor. They are not very significantly in your favor. If you invest for a long period of time, 3+ years, then the chances that you are going to be able to get good returns keep increasing. Even though in the short run, it may not seem like, but our tendency to run away when something underperforms results in missing many up moves when that strategy recovers. So I would say, look at the performance over a long period of time. Make your decisions carefully, whether it is investing with us or anybody else. Once you've made your decision, stick with it within a certain boundary. If the advisor, our portfolio or anybody else's portfolio, is significantly underperforming whatever benchmark there is, it's very important to compare to benchmark, not absolute numbers. If it is underperforming the benchmark by more than a certain amount, let's say 10%, 15%, yes, you should then exit. But if it is performing according to the benchmark or better than benchmark, then you should keep your money in a stable position That's better for taxation purposes. That's better for capturing the returns and the ups and down days. The ups are very, very few. So people who try to time the market usually miss out on very few days when the market went up 3%, 4%, and you were not in the market invested in the product. What's the minimum time? Oh, we answered that. And there is a question. What is the maximum drawdown we can expect from backtest results? It's a great question. I don't think I have the whole chart here. I would, if I, the backtest result is not here. Hopefully we'll be able to provide that by the time this ends. But just looking at the performance over the period that it has been live in this product, you can see that around May to July 2022, I think that is the maximum drawdown probably when it went down from 290 to 240. So almost 50 points on 290, 50 points will be about 15% reduction. So that would be probably the drawdown we had over 2 or 3 months. Similarly, from, I want to say around November 2022 to maybe March 23, it seems to have gone down from 350 down to 295 or so. So that's another 50, 55 on a base of 350. So that's 1 by 7, so about 14%, 13, 14%. So I think it's in that range that we've had a drawdown, at least in the live performance period. However, obviously it has to be compared with what the index was doing in the same period. I think our underperformance is less, much less than that. What is the thesis behind the exit of a stock in this rebalance? So our approach, as I described to you, is a multi-factor approach. We look at 130 plus factors, out of which we figure out what are the factors that are working well in the recent past as well as in this macroeconomic scenario. Based on that, we weight and then weight these different factors and then create a portfolio that we optimize using various risk optimization methods. So it's no single hypothesis. It's not like somebody came up with a hypothesis and say, okay, you know, I don't know, energy prices will go to this level, and because the politics in Ukraine and Russia is doing this, therefore my hypothesis is that we should be investing in utilities or energy or whatever it is. That's not our method. We do not have a hypothesis-driven method for selecting what we are going to buy or sell. Our method is systematic, quant-based. We look at all these factors, which is what we have been looking for many, many years. We score it, come up with a portfolio, and then construct the weights for the individual stocks. Now, what comes out, I've already shared with you, but it is not a hypothesis-driven method. Okay. Kamal Kishore has a question. Is it possible to access platform without any platform, for example, directly from ST website? That's a very good question. We had made that process live. I don't think we do it right now because we don't have the ability to complete all the KYCs and money management on our website. But if there is a lot of demand and there are other products that we are working on, for example, analyzing your existing portfolio and telling you how you can adjust your portfolio to make it a little bit better. A lot of these products we would make available only through our website because they really don't fit with a business model of something like small case and pick, right? Right now, that's not available, but it works. Rajesh has a question. Please provide the date of next rebalance in every rebalancing update or mail the same in advance. Small case was initially shown as date as 29 July. Later, it was changed to 4th September. Very good suggestion. We'll take it upon ourselves to start communicating a little bit more precisely and in advance. So maybe we'll send out 2 notices, one maybe a couple of days in advance, and the second when the rebalance is available. Thank you for that feedback. Captain Hemant Kumar is, what will happen if I exit any of the stock myself prior to rebalancing? Well, nothing will happen per se. It's your brokerage account. You have full control over it. You can buy or sell anything in it. And neither would it impact, I guess the returns will diverge from what our method and all the history is showing. So it will become harder for you to track exactly how your investments were doing and how your investment through our models are performing. So that will become very difficult for you to track. But you can certainly do it, and you have every right to do it if you'd like to manage that yourself. Then there is a question from Kamal or Kamal. I have invested in Gulaq Gear 6 from December 22. I wish to know, should I invest lump sum, or it'll be better to add little amount at time of every rebalance every month? I think we've talked about this quite a bit. The preference would be to invest over time instead of lump sum. However, the only difference is if you have the money available and your overall asset allocation says this is the amount of money you should invest in a product like this, then you don't need to wait keeping the money in savings account and say, oh, I'm going to take 6 months or 12 months to deploy it. It's more meant for when your savings become available, invest them. And if the savings are becoming available as you're saving every month from your paycheck, then that's the right periodicity to do that. I would say popularity of Gulaq is less than the other small case strategies. Are you planning to address it with some sessions in the coming months on your channel? Yes, please spread the word. Please mention if you like investing with us to your friends. I think we need to do a better job of communicating. We spend a lot of time doing research and actual analytical work to build these products, but not quite as much in terms of promoting it. Our style also is to provide the actual information and educate our investors. So for those who like this investment and this approach, please share, follow us on our social media properties, and let your friends and families know. And we plan to certainly do more. I'm actually writing a book. We did an Economic Times webinar. So we are trying to do more to provide this information to investors. Small cap market is at all-time high. Is it a good time for lump sum? So small caps are generally over long periods of time perform better than large caps. They do get overvalued in every bull market, and they also lose a lot of money. We have slight over allocation to small cap relative to the benchmark index, but most of our allocation is to mid cap. So would we say, is it a good time to invest in Gear 6 or not? I would say, look at your asset allocation. If in the last 3-4 months, the returns have been very high and your equity allocation has become more than what you are comfortable with, then don't invest right now. Actually sell some. So keep it in balance with what you need your rebalancing ratio to be, 60-40, 80-20, whatever it is. And that number includes not just what you have invested with us, but your overall portfolio. It doesn't matter who you invest with, because you are the person who is deciding your allocation. So what percentage is in debt and equity is something you will determine. And if that has grown a lot, then reduce it and certainly not increase it. How do you ensure Gulaq portfolio does not become a black box strategy and is keeping on adjusting to changing realities? It's systematic, but it's not black box. It's actually the opposite of a black box. It's completely transparent. In our strategy, we know exactly why we gave what weight to every security. And we can trace it back to all the information about that company that was available exactly. So in that sense, it's not a black box. It's absolutely a transparent box. Now, All of that information is not something that we give out to the retail investor, but inside the company, the model goes from actual information that is available outside from exchanges, from their financials, from what other investors like mutual funds and FPIs are doing, from whether they are participating in index or not. All of that is information that's out there in the public domain. There is a very systematic, transparent flow of that information into our score and a weight. So in that sense, it's not a black box. But you cannot decode it to come up with stories and hypotheses that I'm doing X because of Y that is happening in the market. And that too very simple stories. So that's a big difference that you will find with many other investment managers and Gulaq. We provide a systematic method for investments. We do not provide comforting stories which make the world look very simple in terms of how it operates. So that's a difference. How do we keep adjusting to changing realities? Of course, that's what I was describing to you here. As we mentioned in step 3, we rotate factors based on their recent performance and macro regime. So we do have a view on what factors work in what type of markets. So we rotate them based on that, and that's also systematic. And we have a performance-based measure of saying what is actually working in the market. So it's not price momentum, but factor momentum. We believe that if the factor has been doing well, it will continue to do well till it stops doing well, and then something else will start doing well, and we will give that more weightage in terms of our portfolio allocation. Okay. How will rebalance if the market sudden crash? I think I talked about this already. The market sudden price reduction does not tell you what will happen the next day. Let's say tomorrow morning, God forbid, the market was down 4%. What does it say about Friday? I don't know. I mean, I don't think there is really any data that can tell you that the market will go down further if it went down 4% tomorrow. So we do not react to every single change in the market. We build a systematic plan and stick to it. There's another question. Can we expect more portfolios from Gulaq? So our objective has been to simplify investments. Our objective is not to confuse investors. We don't want to create a separate portfolio for you to say invest in rural India or invest in technology India or invest in defense stocks or invest in Bharat or rural India growth story. That's not what we are trying to do. We are also not trying to give you single factor models and say, here is a momentum one, here is a small cap, here is a large cap consistent compounder portfolio. That's not what we are trying to do. We are trying to do all of that work. That is why we have 130 plus factors and create a portfolio that will work through all types of scenarios. So that's the work we try to do. The breadth of our portfolios is basically based on your risk tolerance. That's why we have different gears. Now, would we do some other products? Yes, we could do an arbitrage kind of a product where it's more applicable for fixed income instead of buying bonds. We could do certain other kinds of investment products, for example, investment index products, which could be done. But right now, there is no plan for doing anything else. We want to stick to a simple approach. We don't want to hide behind, here is a fund, go try a momentum fund. If it doesn't work, we come back and say, here is a value fund, or we come back and say, here's a technology fund, here's unicorn, new IPO fund, or all kinds of stories that people create. We think those are all fads. They are like seasonal flavors. They come and go. But we are trying to build a systematic, evergreen approach on how to invest. There is an average churn of approximately 7 to 8 stocks per rebalance. But don't you think there is a possibility of losing any multi-bagger in market like Bajaj Finance or Page Industry or iShares? Of course, there is a chance of missing out on those stocks or buying, selling, then buying again of those stocks. However, when we have tested these strategies, we have also tested what is our ability to predict consistent compounders over long periods of time. And we have tested many other approaches that are out there in the market. Some very famous, popular books have been written about these kinds of approaches, which simply say buy and forget. And no matter how much we test those methods, we find there is no method which can that we can find that can outperform relooking at the data on a monthly basis. Actually, relooking at the data on more regular basis, but as we discussed, monthly is the right balance between convenience and alpha. So we think that instead of buying and holding a single stock over a long period of time, which is difficult to predict which one is going to be the next Bajaj Finance, which one is going to be the next Shriram Transport or Asian Paints or what have you. Very difficult to predict. So then our approach is more on a monthly basis, look at it and keep adjusting our portfolio. Adjusting for the churn, for the taxes, for the transaction costs, that constant 7 to 8 adjustment every month, we think we can produce better returns for our investors by doing this. That's why we do it. Amit has a question. Do you suggest any minimum amount to invest to overcome subscription amount and get a decent CAGR? We do recommend minimum amounts for every year. The amount as it grows larger, so whatever is the minimum amount at roughly twice or maybe even 3 times that would really reduce your error from what the model is doing. So what you see online as performance return, when you invest the minimum, you may have deviation from it, to some level. And the reason for that is there are always errors that creep in when you're trying to round what is the holding you're going to do. If there is a stock that is 5,000 rupees and you're only investing 24,000 rupees in the overall portfolio and we need to take 20 positions, we can't take a position in a stock like that. So you're going to have a slightly different portfolio. So I would say consider investing about 1 lakh of rupees if you'd like to track without a lot of variation in the portfolio. Is there any qualitative selection of parameters to avoid overvalued stocks and to protect the downside? See, overvalued stock is almost impossible to predict. Stock like Tesla or in India, even HDFC Bank or many of these stocks, they've been trading at a very high PE for a very long period of time when they have gone consistently higher and higher year after year after year. And they continue to trade at a very high PE. So if you were to not invest in these quote unquote growth stocks, which are high PE stocks, so therefore quote unquote overvalued, there is no way for you to participate in companies which are growing very rapidly. So the challenge is, how do we assess whether the company is way overvalued or just overvalued because there is a lot of demand for it and it will continue to grow into that overvaluation every year? That is very difficult to predict. That is why we look at multiple factors. We don't just look at their momentum, we look at valuation, volatility, consistency of their performance. All of those factors inform us on how much should we trust the current level of valuation that this company has. Hanumeshwar from Bangalore has a question. If you conduct it in Hindi, will it be more beneficial for the investor? मैं आपको हिंदी में भी जवाब दे सकता हूं अगर आपको कोई प्रश्न है जो आप जानना चाहते हैं, प्लीज अपना प्रश्न हिंदी में बताइए या बताइए इस क्वेश्चन का जवाब मुझे हिंदी में दे दीजिए और I'll be happy to provide that. Then there is a question about showing the different types of rebalance times like daily, like monthly, quarterly, and annual, and show the performance of each so we can get an actual picture and vote for it. As of now, it is 500% annual churn. We certainly can show you that data. I cannot promise that we would be changing our method based on some kind of a voting mechanism. I think it is our responsibility to do that research. We are happy to share that research with you and show you what would be the reduction. So you have more of an understanding and comfort around why we have chosen to do monthly rebalance. So I will take that down as a next step that we will come back in the next meeting and rebalancing to share with you. What is the USP for your small case compared to others? Since you use algo principle, do you feel the small case is good for the next 8 years? We definitely think this small case is good for a long period to come. Our USP is a systematic, transparent process by which we arrive at these methods. It is consistent, as I mentioned, doesn't get greedy or fearful, and the same method and process goes into it in terms of having dozens of people who have worked for very long periods of time using a large amount of information and computational power to come up with what methods of investments work. So that's our focus. Systematic investments. Why the churn rate is so high for every rebalancing? Is buy and hold not the strategy? As we have talked quite a bit, and in the next meeting, we will share with you what happens if we rebalance only once a year versus what if we rebalance once a month. Of course, the rebalance, if you do once a month, will be much higher, but the return we are able to produce with it is much higher than what we are able to produce if we were to hold it for the year. When you look at that data, you will understand why we continue to suggest to rebalance on a monthly basis. But that may be an idea or a product to say, okay, we will provide a buy and hold portfolio which will rebalance once a year. Because a lot of people, I think, may have preference for not doing this work even on a monthly basis. There's another suggestion: stocks should be 10 to 12. It's better that you reduce to 10 to 12 stocks. When you reduce your investment to 10 to 12 stocks, you increase the risk, and this is called idiosyncratic risk. One of those 10 to 12 stocks can have a huge announcement, like what happened with Adani stocks. And then suddenly your portfolio has a huge hit because of what happened to one or two stocks. So a good investment principle is what is called diversification. Diversification means you invest in a diversified set of equity investments so that any specific risk of scam, risk of bad luck with some kind of a business outcome, regulation, change in market situation for any given company does not impact your overall investment too much. So reducing it too much and taking a very concentrated bet on just 10 stocks is a very risky way of investing, and not one that we would recommend or follow. We believe in diversification, and actually the more money you have to invest, for example, our PMS strategy takes position in 70 to 80 stocks rather than 20 stocks that we do in a small case. So actually, as you invest more money, we recommend that you diversify even more to get the best results possible. Kushal Brol has a question: given that the small case has given a strong run during the last few months, is it still advised to invest into it now? We rebalance every month. Every month is a new position that we are taking. We don't have any view on whether the performance will continue at the same level, go down, go up, in which month, what would happen, something we cannot predict. If you evaluate it on month-by-month basis and try to time it, I don't think that is something that we can do. If we can't do it with all the knowledge we have about the product, I would strongly suggest that it will be difficult for you to do it also. So again, evaluate investment strategies on longer periods of time rather than month to month. Captain Hemant Kumar has a question: do you provide analysis report of each stock picked up? I believe it is mandatory for SEBI registered advisors to provide his clients. I'm not aware if it is mandatory to provide a research report for every stock picked up. It is mandatory to have a rationale on why we have picked each stock, and we do have that. We do process and keep our scores on what was our score for each type of a factor. I'm not sure if it is mandatory for us to provide that to every investor. We will look into that, and of course, we'll do it if it is mandatory, but that's not my understanding. Okay. Is it possible to share Gear 6 full backtest report, like 10 years or more, for long-term conviction? Absolutely, yeah. I think if it's not there online, we will make it part of our next month's presentation. I have subscribed recently to Gulaq Gear 6 and invested 2 lakh lump sum last week and today. Is it correct decision? And Veshwarji, that depends on what your overall portfolio is and what your risk tolerance is. If the total investment amount is 2 lakhs and this is the money you need for some near-term goal you have, then it's not a good decision. If it is 5% of your overall wealth and you're saving it for your retirement, it's a great decision. Don't worry about it. Sarat Chandra Ripka has a question. Is there an upper limit for the money that can be invested? No, we don't put any upper limits. Actually, in some sense, that would be because we charge a fixed fee independent of how much you invest. So actually, if you invest a lot more, that's a better return on your investment in terms of getting a fixed fee product for your portfolio investment. Sudhindra Hola has a question. Is it a good idea to add additional investments after rebalance of stocks, or can we do it any time of the month? The rebalance has a decay period. Every time you rebalance, the return expectation of that portfolio is what we expect to be the best when we rebalance. Now, the next rebalance will be a month later. So if you invest closer to the end of the month, whatever benefit you would have achieved by investing in our portfolio would not be there anymore on the last day. So whatever was the expected return that we were supposed to get decays from the period we rebalance to the next rebalance. So I would recommend that if you're trying to add money, do it along with rebalance. That's the best time. I did a rebalance in Gulaq Gear 6 small case. Before the rebalance, my total investment was 8,06,000 something, but after the rebalance, it was 8,01,791. And even before placing the order, I had to add 7,000. I wouldn't be able to comment on your specific situation, but Swapnil, if you are willing to send us your statements, we would be happy to analyze and understand what was going on. It could be for many reasons. It could be that stocks that you sold and the time that you bought the new stock, the prices changed or something happened. But we'll be happy to analyze it with you and understand what happened. In ideal situation, you should be paying some money for your cost of execution, but the portfolio shouldn't be changing too much in value. And now this seems like it's a 12,000 rupee difference on an 8 lakh portfolio, which is a 1.5% difference. That's a very significant difference. So I don't think that should be happening. And we are happy to look at it in detail for you if you would share with us your statements. Vivek has a question. I subscribe to Gulaq due to your strategy of using all cap stocks like large, mid, small, while many of the other calls usually only small cap for higher profit but very risky. I agree. We have a multi-cap approach. We look at the BSE 500 as our universe. So we are looking at the top 500 companies, and we are agnostic on multi-cap, but it so happens that opportunity rotates. Sometimes is in large cap, sometimes in mid cap, like now. As per SEBI norms, delivery share when we sold 20% margin, not available in the current date and not buying. So what can I do? Last example, IRFC. Okay, Utpal Mishra ji, your question, I guess. Yes, so SEBI has made brokerage accounts to be pre-funded. So there are two approaches to achieve that. One is if you have some extra money in your brokerage account, then you can buy and sell the same day. If you don't have that additional money in your account, then you'd have to do the rebalance over, two stages. In the first stage, you will sell what is being advised to be sold. In the next iteration, you will buy what is being advised to be bought. So unfortunately, that's the regulation. There is not much we can do about that, but those are the two methods. Okay. I do have the answer for the maximum drawdown. It was 18% as we were looking at it, and it was from October 21 to June 2022. The benchmark lost 18% and Gulaq lost 9%. So our underperformance was 9. We did better than the benchmark, but we still lost 9%. And that was between October 21 to June 2022. So that is the drawdown number. If you look at this data here, October 21 would be somewhere at this point, and June 22 would be, so I don't know if you guys can see my marker, but it'll be from this peak to this trough. We lost 9%, whereas the benchmark lost about 18% in the same period. Update a fact sheet on small case. Yes, so we do provide updated information on price to book and other information. It is pushed around 9 p.m. So it gets updated by 3 a.m. So if you look at it next day, you should see updated information on the fact sheet on the portfolio. MDD for the benchmark is 18%. We do think we can underperform that and we can have a 20% loss. So we have set our MDD or max drawdown to 20%. And that's what we have seen over 15 years of historical backtest that has happened with us. But these are in different period that happened. So obviously, when we lost more money, we obviously were underperforming the index in that period of time. Another question, good time to invest additional money in gear 6 or wait for market correction? I think I've answered this a few times. Please don't try to time the market. We won't be able to advise you on that. What is the proportion of lump sum and monthly SIP? As I think we have discussed, it depends on what your source of income and savings is. Also depends on what your overall allocation is. So as money comes in, keep allocating it to your overall investment portfolio. Time it in a way that if one has gone up a lot, invest in the other part of your portfolio so that your overall ratio remains roughly constant. From where can we gain same knowledge as you have so that we can understand why rebalance is happening in depth? Pramodji, there is, if that is of interest to you, obviously you can spend time learning about quant investing. There are lots of books on the topic. Famous Chicago University has been publishing about this for last 40 to 50 years, starting from Pharma French, who got the Nobel Prize in this area, to many other people. There are large companies. We publish a lot of material on our social media properties where we keep talking about how to build these models. I'm writing actually a book which will be coming out. It has a whole section on how to invest and how to build quant models as well. So many sources, and of course every month and sometimes even more frequently we provide more detailed information on how to do this investment. What is the capacity of strategy in terms of maximum AUM before the strategy faces illiquidity? The capacity of these strategies is very high, several thousand crores, if not more. Right now, we are nowhere close to that amount of capacity, and we are actually investing much more money through our other products into the market. So we don't think that this is an issue right now. The implementation, when we do it in the retail format, people do their rebalancing at a very different time. So somebody would do it at at a particular time in the day. Somebody else may come 15 minutes later. That means there is no specific pressure on buy or sell at any given time. So the impact is really distributed over a period of time, which means that this amount of investment that we have with our portfolio is not having any measurable impact on the portfolios yet. Can we get 1 year subscription plan in Gear 6? That's a good suggestion. I would have to defer to my team on whether it can be done or not. I know we have focused on 6 months. I think there is actually a regulation which requires a certain level, but I'm not sure. I'll have to wait to get the answer to that. Discuss about fund manager investment philosophy. I think I've tried to answer that quite a bit, but to recap, our investment philosophy is quant systematic investment. Here is our process that I mentioned already. We look at quant factors, over 130 of them. We select the ones that work based on their performance and the macro factors, and then combine them systematically to come up with what portfolio we should hold. One more question. Can we receive emails for adding lump sum or more money when you feel the small cases are undervalued as this will enable us to add more money at somewhat appropriate time? Mr. Trophy, I'm not sure I can help you with that. As I've been trying to tell you, we do not have any insight on how to time the markets. We actually cannot tell you when the markets will do better or worse. We have tested that logic many times, and I haven't been able to figure out how to build a predictor for that. So it should be based on your overall asset allocation, and you should keep rebalancing it, taking into account when your equity portfolio has done very well, don't invest in it, invest in your fixed income part. When your fixed income has done well or equity has done poorly, that's the time to invest in equities to keep the balance constant. Since there is a gap between your recommended date and my execution date, can you provide a range for buying range, please? So you're saying, can we provide a range of price at which you should be executing? I think that is going to be a little tricky because the prices tend to move in sync. So if the index is down 2%, most stocks will also be down somewhere between 1.5% to 2.5%. So if we provide price range for just one stock, I don't think it will do justice for you, because it depends what has happened in the overall market. Even though the stock is down, let's say it's up 1%, and you say, oh, now it has become expensive, but maybe the index has gone up 1.5%. So it is actually even better purchase now. So good suggestion, but I'm not sure we can really help you with that. I think we need to do better job of communicating so people are aware when they have to rebalance and reduce the chances that they have a big gap between what we are seeing and what you're doing. During election season, what is your experience? Just stay invested or come back after results? Our experience, we haven't specifically backtested the election results and what the impact of that would be. I think it's a good suggestion for analysis as election season comes up. So we will look at doing that. So we'll come back and answer that for you. I'm a bit afraid that market is all-time high and I have a big amount available. Should I wait for correction and then invest? Kamalji, I think I've answered this several times. Nobody can predict whether the market will go up another 15% before it corrects, or it will start falling tomorrow. Nobody can predict that. Certainly, we cannot predict that. And if somebody is telling you they can predict that, be very skeptical. So I'm not sure we can answer that for you. Again, we will guide you to this chart that things look scary or not scary when you look at them in 1 year periods. But when you look at 10-year periods, they don't look that scary at all. Also, if you look at this chart, at what period would you say, oh, I shouldn't be investing anymore? It's impossible to know what the next bar will be. And so again, trying to time the market is very unsatisfying exercise. Recently, while rebalancing, the next day we saw IRFC shoot up 15%. Should we still enter or wait? That is probably, I don't know what our models were seeing, but 15% price growth is probably quite a bit already. Again, if there is a big gap from the point we issued our rebalance to what it is right now, impossible to tell us unless we rescore the model. I don't know what the rest of the market did. I don't know what else was going on. Maybe they announced some results which are much better. I can't answer that in absolute terms for you. What is your view on PSU stocks in general? As we see, we have few in the portfolio. I cannot comment on any specific stock in general. I can share with you what has been the best returning stocks for us. These were the top 3 performers: Kalyan Jewelers, Cyient, SGVN, and the worst performers where we lost 2 to 5% as well. So these are the best performers and the worst performers in our portfolio, but I don't have any specific view on individual stocks. लॉन्ग टर्म के लिए आपका पोर्टफोलियो कंटिन्यू कर सकते हैं क्या? अमेय जी, बिल्कुल हमारा ये विश्वास है और ये प्रयत्न है कि हम आपको ऐसी प्रोडक्ट्स और इन्वेस्टमेंट मेथड्स बना के दें कि आपका विश्वास जीत सकें और आप हमारे साथ लॉन्ग टर्म तक जुड़े रहें और आपका इन्वेस्टमेंट पोर्टफोलियो हम अच्छे से मैनेज कर सकें. Can you tell me some more about your PMS products? Avya Sharma, sure, we can set up a follow-up call if you'd like. If you'd send us I guess, I don't know if you have your contact information. If you're an existing client, we may be able to follow up with you. We have a arbitrage fund which has been running for 15 years. It has never lost money in any month. It is comparable to cash future or arbitrage funds that many mutual funds have, but performs much better because we are very technologically driven in that fund. We have a long alpha product, which is very similar to the Gulaq product, but more diversified. So those are the 2 PMS products we have. We also have what is called allocation alpha, which combines these 2 products and keeps it balanced, what I was suggesting. So it does that automatically, but we can go into more detail if you're interested. Anand Kulkarni has a question. I saw rebalance update option is getting enabled lately on app. A notification was showing on September 1, and after September 2, I saw the button is enabled. Thank you for pointing that out, Anand Kulkarni. I'm asking my team to respond if they know what was going on, but clearly there are some issues around communication and when actual rebalance can happen. So we will try to address that. Should SIP be synchronized with rebalancing? Yes, as I discussed earlier, that's the best time to adjust your investments. Ratmesh has a question. Should we definitely change the way rebalancing happened? Till the day of rebalance, some of the stocks lost again. I'm not sure. I understand the question. I think it's a comment. So you invest in FNO derivatives hedging for holding shares or not, or for hedging position or only equity. This product in RIA is only equity holdings. In PMS, we do have FNO trading, and we provide some other types of strategies like covered call writing and other things we can look into. But in this RIA product that we have, it's only long equities that are exchange traded. There's no FNO in this. Okay. Have attended the last 2 months rebalance update videos and the backtest results were requested in both of them. Can you please share them so that we can have more conviction in the strategy? Yeah. Well, January 2012 to June 2022, backtest results were 3,400% returns versus 310% return in the benchmark. The MDD month on month was 13% in Gulaq versus 12% in BSE 500. This is the backtest data. I guess there is clearly demand for showing this in more detail. So we will take that as feedback and make sure that we present that data for you. Sanjeevani has a question. Yesterday I've done the rebalance and again today I put 10,000 as lump sum, but today it only invested in 5 stocks. Why it got invested only in 5 stocks instead of all? So 10,000 is less than the total amount. So when we do rounding, it is possible that it did not get a full unit of some of the other stocks beyond the 5 that it invested in. Again, if you are willing to share your ID details with us and your statements, we can look into it and get back to you with a confirmed answer. But that's my guess, because our minimum investment is about 24,000, if I remember correctly. So 10,000 would only give you a partial replication of the product in terms of what you get added. Sridhar has a question. In case of market meltdown anytime, would you be suggesting to sell off the portfolio completely and sit on cash or just stay put invested? I would suggest just stay invested. Selling at the bottom of the market is the worst way of, I guess, panicking and losing your life savings. Stock market investment is volatile. It goes up and down. You should not make your decision based on what has happened in the last 1 month or 2 months. You already know, if I look at this chart, that there have been years where 52% of the portfolio value was lost. On several years where 40% or more money was lost. So if there is a market crash and you exit, then you don't get the kind of performance that we were talking about here. So there will be periods of correction and then there'll be periods of gain. And nobody can tell when that correction will end and when the gain will start. So going in cash and trying to time it on when to re-enter is not a successful strategy. And I don't know of anyone who's been able to precisely get that right. Thanks for Gulaq Financial Services. I'm investing in Gulaq 6, over 15 lakhs. Shall we go for profit booking periodically or shall we wait for a long time while our surplus for long to get compounding? It depends on what your overall portfolio is and how much money you have invested and your overall allocation. If this is a part of your overall equity allocation and this has grown a lot compared to your other investments, I would say sell some and rebalance. If others are also doing comparably, then don't. If you have fixed income and equities have gone up a lot, then again sell some and rebalance to the asset allocation ratio that is right for you. Okay, I think I already gave you the backtest results, but again to recap, from January 2012 to June 2022, the returns were 3,400%, so 34x versus 3.1x returns on the benchmark. The MDD that we experienced in this period was 13% and 12% in the BSE 500, which is our index that we are comparing ourselves to. How much should be the percentage split for Gulaq gear we should put in the equity totals? Say I have 5 lakhs to put in equity after my consideration for debt. Gold, how much should it be in Gulaq 6B? So if your total is 5 lakh that you want to invest in equities, I guess that's what you mean. This is Sunny's question. I would say that a single manager risk is what you will get if you put all that 5 lakh in Gulaq Gear 6. So you may choose to say, okay, I'm going to use 2 or 3 managers and then allocate accordingly. I think that would be a sensible strategy, because when you concentrate either in stock or an advisor, then you are taking the risk of that advisor or that stock. I saw that rebalance update option is getting enabled lately on app, but notification. Okay. So our response is, this looks like a problem with small case platform. We will take it up with the small case team. And I guess we'll respond on the comments as well. And if we have your contact information, Anand Kulkarni, then we'll get back to you. Shakti has a question. When was the last time you have updated models? We are continuously searching for new factors, new ways of interpreting data. And roughly every 6 to 12 months, we would probably inject some new factors into our library. I don't have the exact date of when this model was updated, but that would be a fair estimate of, on average, how frequently we look at, I won't say changing the model, but adding, appending, modifying, and fine-tuning the model. Roughly 6 to 12 months would be the period. Okay, we are now at 1.5 hour mark, and I think we are out of questions. So thank you very much for being investors with us, and happy investing. I know there are concerns about being at the top of the market. It's difficult to predict what is going to happen next month. And as long as your overall allocation is solid, we will continue to ride through the ups and downs and make good returns over longer periods of time. With that, I will close. We have several things that we have talked about that we'll show you in the next meeting. We will discuss those and be ready for the next month's rebalance meeting. Meanwhile, follow us on our social media. If you like what you see here, talk to your friends. If you don't like what you see here, talk to us and we'll make it better. Thank you very much. Take care.